Module 12, Unlocking Optionality in Investing. Now, optionality is a very commonly used term in markets, made more famous by Nassim Taleb's books and lectures. But I think optionality is one of those misunderstood concepts in investing. And this is why I dedicated a whole module to it. Let's start. What is optionality? How to capture it, examples of optionality, front and back-ended optionality, 3 investor archetypes, that is 3 types of market participants. It's important to understand them to see how they approach the market, and finally, traps and reversals. Now, what is optionality? Everyone talks about optionality as if they know exactly what it is, how to get it, and they talk about optionality in a way that suggests everyone has agreed on its meaning. For me, optionality is simply having more upside than downside. That's positive optionality. So if you have 3 units of upside and 1 unit of downside, 3x, then it's a 3x. And the higher the ratio is, the more the optionality. 10x is better than an 8x, a 5x is better than a 3x, and so on and so forth. We talked more about the convexity and concavity in case study 3, where we talked about banking versus software. Now, how can you capture optionality? First, as we just explained, you have to think in risk reward. On a given trade, on a given investment, on a given trade setup, even a real business. Optionality is not a concept limited to financial markets and public equities and trading. It can be in the real world. It's a broader concept, can also be applied in life choices. So if you develop a way where you can think of decisions in risk reward, then that is an important platform that you can use to extract optionality. So thinking in risk reward, a 10% downside on this trade, but I can make 70%, then that's a 7x. Second, understand the business model. What do I mean by this? When you dig deeper, when you scratch the surface, when you learn more about a business, then you are better able to understand how that business can or will behave going forward. 2 years out, 5 years out, 10 years out. Can margins expand from here? Materially, it could be at a 5% or a 10%, and everybody thinks that they can't move up, but you have an insight, you know something about that business or that sector or even that geography that could help margins go up. That's an insight, that's an advantage that you have against the others. Maybe the business is capital intensive and you believe it will become less capital intensive. Again, we talked about all these concepts in previous modules. Moving on, it's important to develop the skill of being able to think probabilistically. It's not just, I may lose 10% or I may gain 70% and just a 7x. No, it's not that simple and linear. You have to be able to assign chances and probabilities to each scenario. There's a 20% chance that this equity explodes 20, 30 times because their technology is adopted or they sign a big contract or consumers adopt that brand. And there is a 20% chance that it fails and a 60% chance that it does a 5x or a 10x. So you have to use probabilities and range of outcomes, calculate expected value, calculate a number of scenario, and that those simple numbers will give you your risk reward. Finally, buy cheap exposure. Now, buying cheap exposure is a sort of way to get a lot of optionality easily. Now, let me give you some examples. Maybe the price of copper or silver or gold is in the doldrums because of a cyclical low in the market. Maybe uranium is selling off, sentiment is weak, the narrative is very negative on a given sector, on a given commodity, maybe oil and gas, maybe a specific economy. If you manage to buy exposure at cheap prices, then when the narrative turns, when that industry turns, you can make 10x, 30x, 100x. Again, every situation is different. I'm not throwing these numbers out because they have to mean something. You can make a 10x, you can make a 100x, depends on the setup. So buying cheap exposure gives you a lot of upside, but every situation is the same. Many times when something is very cheap, there could be a lot of financial leverage embedded in that setup, so chance of bankruptcy is very high, or operating leverage, again, very high business risk. So both can make the value of that security as zero, but again, the upside is open. So you have to decide what kind of bets you're looking for, where on the spectrum of risk reward you're trying to play. Again, every case is different. Now, this is a quote by famous author and trader Nassim Taleb. The payoff of a human venture is, in general, inversely proportional to what it is expected to be. And how I understand this quote is that the involvement, the actions, the thinking of human participants in a market, again, whether public, non-public, equities or not, the way the human views that setup is one of the most important functions in deciding what the payoff of that specific venture is. Because, for example, if the market believes that crypto will be adopted and there will be positive regulation on crypto, or the market believes that every country in the world will push for nuclear energy and there will be nuclear energy proliferation and new technologies discovered and adopted, then if the market prices that in, then your payoff is very limited. Actually, your payoff could become negative in many scenarios. So for me, this is just a quote that says that the best advantage you can get is against others playing that market. It is against other humans. It's not just analysis or maybe trying to predict the future. It's many moving parts, and how humans see that payoff, how the market prices that is one of the most important ones. Now, front-ended optionality. What are we seeing here? The payoff, I assumed it's linear. It's a given payoff, say $1,000. And you see that the price is slightly below that, say 800. And there is a $200 opportunity. And assume that payoff is long-term value. Okay, so if somebody buys that security, over the long run, he can make a $200 spread on that. But something happens, a bad earnings call, bad guidance, black clouds gather above that business or that sector, disruption, business threats, you name it, and all of a sudden the price of that security crashes and crashes and crashes. Now, the spread between where it was and where it is, given the payoff over the long term stays fixed, is your potential. This means that a crashing price could give